Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields holding the range again. Call last week, we did finally bust through 290 to the downside, extending that range, that short-term range between 290 and 3% back to 280 to 3%. It's been kind of a trade 280 to 290. We sit there for a while, then we move up, we trade 290 to 3%. We sit there for a while, now we're back into the 280, 290. Let's just take two giant steps back and say, why don't we just call this range 280 to 3%? And in order to see a major move, we're going to need to see a trade north of 3% yield, which we have failed to do time and time again, or we need to get back down below 280, which again is going to be very difficult as well. I think 275 is the line in the sand down to the downside. That's going to be the uh-oh level. So even if we do kind of dance around 280, I don't think it's going to bring out too many, it's not going to scare the market too much. I think right now the market is continuing to watch and wait. The Treasury market is very stubborn as the rest of the world. We've seen currencies trade, we've seen equities all over the map, we've seen commodities trade. But equity's been very caught in this tight range and will continue to do so. Perhaps the smarter trade is to watch treasuries and see where they go, as opposed to all the geopolitical rising risks and whatever on the outside that seems to be capturing all of the headlines. And if you look at market volatility, it did see a modest uptick today. When we look at treasury volatility, we got back to the 14-day moving average. It's a level that's been very difficult for treasuries to hold, suggesting that we probably will bounce off it. We did see a lot of volatility selling today in the Treasury complex. Recall, you got to go back to May for the last time we saw any sustained trade north of the 14-day moving average. Again, that's a good mark to watch. If we do trade above it again, it does mean the market's probably looking at some concern, not yet fear. We won't talk about fear for some time, but concern is something we'll talk about. But typically we hit that 14-day and we bounce right off it to the downside. If you look at what's going on around the world, we're looking at things in Europe, currency issues in Turkey that's spreading and rippling out to other emerging markets and equity markets. That's really what's causing this trade. So if you look right now, that is the focus. But if you look at the greater, bigger picture here, it's not really what the Treasury market's looking at. I think the Treasury market remains, has one eye on what's happening in the emerging market and what's going on in Europe. But really the focus here is going to be September FOMC, the statement and the forward guidance and the presser. Those are all things the market's concerned about. Likewise, it will continue to watch that yield curve, the 2-10 Treasury curve, which didn't make any real big moves today. However, that is something that is going to be a big concern in the Fed raises rates in September and possibly again in December. How will the market keep that yield curve positive, or at least from going close to negative? That is something that the Treasury market has been very keen to watch, and I think is one of the reasons why we've held this range in the back end of the Treasury curve for so long. It's kind of waiting for some outlook, whether it's GDP related, whether it's inflation related. We're getting it on the geopolitical risk side. Although we haven't seen an overreaction in the bond market, we certainly aren't seeing yields go higher, which in all seriousness they should be, with all the issuance going on and expectations of higher yields in the lower end of the curve. So right now, the Treasury market sits, waits, and watches. But don't be surprised if we see yields continue lower here with concern over what's going to happen after the Fed meeting in September if that yield curve continues to decline. This is Todd Colvin coming to you from the floor of the CME Group.